BJ, you used to work for the IRS. How many years were you working at the IRS?
Hi, Josh. Yes, after 23 years at the IRS, I figured it was time to switch sides and help people stay out of trouble instead of finding it.
So 23 years at the IRS. How many of those years were you inside the IRS auditing crypto cases, specifically dealing with taxpayers who thought they were invisible?
Well, specifically dealing with crypto cases, that was about 10 years of my IRS career, I would say.
Out of 23 years, that's quite a bit. So when the
It
IRS
is.
opens a crypto audit, what are the first things that they pull? And what makes
Well,
somebody instantly appear on their radar?
what triggers the audit? It's kind of like a million-dollar question, I would say. And to be honest, audits are not really random. They're all data-driven. So for digital assets, triggers would include big discrepancies between what you reported on the tax return and what exchanges report, what the IRS knows about, and not only in the audit year, but also in prior years. So let's say Coinbase files a 1099 for year 2021 and your 2023 is under audit. The IRS typically expects to see some crypto reporting in 2023. And if there isn't any, that may be a red flag or a lack of crypto reporting at all. Typically, IRS gets a lot of data from exchanges, so they see that you're involved in crypto, and it's a good idea to report all those transactions.
So what do taxpayers think that the IRS doesn't have, but they already did?
That's a good question too. The IRS can see a lot of information. They can see a lot more than people think. Back when I was the only virtual currency subject matter expert service-wide, we used tools like Chainalysis and TRM to trace blockchain transactions. It's not like they have a live feed into your personal wallet, but exchanges do report via 1099. So and especially if you're on a foreign platform, foreign exchange platform, the IRS does have data sharing agreements also with other countries through foreign exchange information agreements. Plus, if you're audited, IRS can subpoena records. And in fact, that's how the IRS obtained crypto records originally. The IRS knew there was a lot of people who got into crypto with some more prominent platforms, but there was no reporting for crypto transactions back then. So what the IRS did is they served something called a John Doe summons on some exchanges to obtain the identity and the records for thousands of taxpayers. And that's how really the digital asset compliance campaign stood up. They used those records to develop cases, but honestly, most folks aren't under constant surveillance. It's more about patterns that pop up in data analytics.
Okay. Now, you mentioned something earlier about most people think that because they used an exchange or a wallet or tax software, that they have that as a defense. In your experience, what defenses actually work? I mean, that doesn't work. What does work?
Yeah, one of the biggest mistakes that people make, and that's really what makes people get crushed in these audits, is underreporting gains. Some folks think that I didn't cash out of an exchange, of a cryptocurrency exchange, so those transactions are not taxable. That's wrong. I mean, all swaps and all exchanges that take place within the exchange platforms are taxable. So they have to be included in your tax calculations. Another one, incomplete records. Those can kill you too. If you cannot reconstruct your transaction history with tools like blockchain explorers, that can put you in a lot of trouble.
So you did all these field audits. Why do so many crypto audits get kicked out of correspondence audits and straight to the field agents? And what does that say about how serious the IRS thinks that a case is?
Oh, it is very serious. Most of cryptocurrency audits are conducted by revenue agents. They're not correspondence audits. The first step that the IRS does when they get those audits is they analyze the records that they already have in the case file, and they analyze them for additional leads. Additional leads do take time. First, they request records from the taxpayer. If they cannot, they go straight to the exchange. It does take time. That's why they typically, with the revenue agent, they have a better way to deal with voluminous records and audits that take more time than a typical correspondence audit would take.
So once it's in the field, is the IRS still doing fact finding, or are they
Oh,
already building
absolutely.
a case? Yeah.
Oh,
Okay.
they only have skeletal records when the case ends up on an examiner desk. Sometimes the records that they have are not for the year that's under audit. So what they do is they analyze those records, build up the case, get additional leads, and try to use those records to kind of put their foot in the door, so to speak, to develop it for the current year.
So when someone's cheating or underreporting or hiding crypto income, what are the obvious red flags that the IRS sees immediately? And how far back can they go once they see them?
Let me address the second question first, because it really depends on your statute of limitations. The typical statute of limitations on the assessment of tax is 3 years from the time that it was filed. That's normally how long the IRS has to open the case and make an assessment. But in their situations, there are exceptions that will apply to normal statute of limitations. For example, if the unreported income, not only cryptocurrency related, but other income as well, if the unreported income is at least 25% omitted, that will give the IRS additional time to develop the case, and the statute is automatically extended to 6 years. What triggers those audits is lack of reporting and gaps in reporting. So, for example, the IRS knows that a taxpayer should have some transactions reported from a certain exchange, but the taxpayer doesn't report them for some reason. That's what can trigger additional scrutiny.
So what's the moment that a crypto audit goes from just being a civil tax matter into start becoming something else, maybe more criminal?
There are a couple of instances where an audit can switch from a civil case to a criminal case. First of all, if the income is large enough to trigger interest from the CI, from the criminal investigation. They're typically not going to pick up a case unless it's at least about $40,000 of unreported tax per year. Another issue that can trigger a shift into the criminal case is when the taxpayer is involved in some criminal activities. The case may be referred to criminal investigation for the scrutiny from them. Hiding assets. Sometimes taxpayers used to use mixers to obfuscate their cryptocurrency activity online. That can sometimes trigger a criminal investigation involvement.
Well, Vijay, thanks very much for sharing your wealth of insight. Again, I help people with IRS problems and getting out of them, finding the best exit strategy possible. If that's getting you current on your taxes or settling for less with the IRS in an offer and compromise, or you're being audited and you've got a crypto audit. My link is in below in the description if you want to grab a spot on my calendar. I hope this has been helpful for you and wish you the best moving forward.